Hi, I'm Shawn Hyde, a business appraiser with over 20 years of experience in the valuation industry. And I was asked to talk about valuation multiples and how those are appropriate for use in the valuation of a privately held business. So you might have seen in the news sometimes there's a discussion about how somebody's paying 5 times or 8 times or 12 times EBITDA, earnings before interest, taxes, depreciation, amortization, for a specific company. And you may be wondering, well, shouldn't my company be worth that as well? Maybe, it depends. So most of the transactions that make it into the news are much larger companies. There are much larger dollar amounts. If your business is not generating revenues, in the $50 million or more, it may not be that famous. So what we do in the business appraisal industry is we look at transaction databases. We look at transactions that have been sold across the country, and we compare your business to those. Now, those databases don't have an awful lot of information. They're fairly limited, but we can do some industry comparatives and comparing your company's financial ratios with those of the industry average, with the assumption being businesses that operate in the average realm with the industry average financial ratios are probably worth something around the average market multiple. And if the data shows that the average market multiple is 2 or 3 times EBITDA, then that may be where you're at. However, if our ratios that we look at indicate that your business is stronger than the industry average, well, a stronger business should be worth more. And so we'll look at those multiples that are in the upper part of that range. Instead of the average or the median, we'll look at the 75th or 85th percentile, see what that does. Now, you also have to be careful, because if your financial ratios indicate that the business is weaker than the industry average, the opposite is also true. Instead of an average 2 or 3 times, you might be looking at a multiple that we would select in the range of 1.5 times. Some folks will ask me, hey, how can I make my business make more money? I'm always trying to do that so I can get those higher multiples. Well, part of the fun is when you file your taxes, if you're hiding all the income you can for income tax purposes, right? You're minimizing that 21% federal income tax and depending on what state you're in, 6 or 7% state tax. So you're hiding $1 to save 30 cents or so. Depending on how egregious you're being with those adjustments, in the valuation world, the bankers, lenders, and buyers, they might look at those and say, they don't believe them. So if you really want to make sure you're showing more profit on your tax returns, pay more taxes. Instead of cutting your nose off to spite your face, that 30% that you're trying to save, well, if you reported it, you could be paying or receiving in a transaction 3, 4, depending how large your business is, how profitable you're showing, 5 times that dollars in value. So if you have a question regarding valuation, let us know. Be happy to address that in a later video.